SpaceX has published its first quarterly results, and the figures are both extraordinary and rather alarming. Revenue rose by 92%, its loss almost halved, and the company spent more than $18 billion on capital expenditure in a single quarter. In this video, we are going to look at where the company stands today, when it might finally become profitable, and whether investors should already be considering buying the shares. I'm Daniel, a former London stockbroker and the founder of Investor Edge Academy. Let's crack on. Before we get started, drop in the comment whether you would buy SpaceX shares today. Then at the end of the video, I'll be interested to see whether your original view has changed or it hasn't changed. Let's begin with the IPO, because SpaceX has followed the classical IPO pattern almost perfectly so far. Of newly listed companies, 57% are still trading above their offer price 1 week after they went public. 6 months later, however, only 43% remain above their IPO price. In other words, the first few days often filled with enormous enthusiasm. Everyone wants to take part in the new and exciting story. Then, once the novelty begins to wear off, investors start looking more carefully at what they have actually bought. And this is exactly what happened with SpaceX. When we look at the valuation, it remains extraordinarily high, even at the current share price. That said, I do not really believe in that a single valuation metric can tell us whether a company is a good or a bad investment. Take Amazon, for example. If you had looked only at Amazon's price-to-earnings ratio throughout most of its history, you probably would have never bought the shares because they almost always appeared overvalued. But the company kept reinvesting its money, building infrastructure, and eventually creating businesses such as AWS, which completely transformed its profitability in obviously a positive direction. And the same question applies to SpaceX as well. The important point is not whether the company looks expensive based on its current results, because it clearly does. The question is how much revenue and profit the rocket, satellite, and AI infrastructure being built today can generate 5 or let's say 10 years from now. Personally, I expect both revenue growth and improving profit margins over the next few quarters. The real question is whether the improvement will be fast enough to justify the current valuation. To answer that, we need to see the company's 3 divisions separately: space, connectivity, and AI. Let's begin with the space division, which is essentially the rocket business. Space revenue reached $962 million in the second quarter. That represents a growth of 55% compared to the previous quarter and 29% compared to the same period last year. The interesting part, however, is that the total number of launches actually fell from 46 to 38 year-on-year basis. So how can the company generate more revenue from fewer rocket launches? Well, it's not rocket science to answer that, because the answer is that not every launch is worth the same amount. There were fewer launches overall, but the larger proportion of them were high-value customer missions. Despite that, the division remains loss-making, and the main reason is, of course, the development of Starship. SpaceX is not simply trying to build another rocket. It is trying to create a fully and rapidly reusable system, which, according to the company's plans, could carry 4 times the payload of the Falcon 9 rocket, while reducing the launch costs by as much as 90%. And that costs money, actually a quite great deal of it. Viewed in isolation, the space division is clearly loss-making, but it also provides the company's genuine competitive advantage. It allows SpaceX to launch its own satellites more cheaply and more frequently than any other of its competitors, making it possible to build Starlink, Starlink Mobile, and potentially space-based AI infrastructure in the future. And if you have not heard much about Starlink Mobile before, there is a reason for that. This was the first time the company discussed it in any meaningful detail. And that brings us neatly to the next division, which is connectivity, which is primarily basically Starlink. Not every figure here was quite as strong as investors had initially expected. Well, the number of Starlink subscribers reached 12 million, while the market had expected, well, something closer to 12.5 million. Still, it is hardly a poor result, we have to acknowledge that. The company added 1.7 million new subscribers, making this the strongest quarter in Starlink's history for customer additions. One potential problem, however, in the future is ARPU. Not necessarily today, but perhaps 2 or 3 years from now, which is why it's worth discussing it now. ARPU stands for average revenue per user. It tells us how much revenue the company generates from the average subscriber each and every single month. It currently stands at $66 compared with $85 a year ago. Now, this is obviously per month. But why is this happening? Primarily because Starlink is entering more countries and it cannot charge US prices everywhere. The company has also reduced subscription prices in existing markets to attract more customers. This is a normal behavior, of course. If you wanted Starlink internet in the UK, the monthly price would have been around 75 quid just 2 years ago, but today it is roughly £40 per month. The management also expects ARPU figures to continue falling. That is not necessarily a problem while the company is adding hundreds of thousands of new customers every single month. However, the question is not how we will stabilize the business in the future once customer numbers are no longer increasing at such extraordinary rates. Perhaps the most important change in the Starlink story, however, is that the division is no longer about residential internet subscriptions. Customer revenue was roughly around $2.5 billion, while enterprise and government revenue had already reached approximately $1.8 billion. The latter grew by 108% year-on-year, meaning it expanded far more quickly than the customer business. Elon Musk also said during the earnings call that I would expect enterprise revenue to substantially exceed customer revenue. Well, in other words, he expects revenue from companies to become substantially greater than revenue from residential customers like you and me when we buy internet from Starlink. Why could this be the case? SpaceX is signing agreements with growing number of airlines. This is the equipment installed on aircrafts that gives passengers the internet connection while they are simply flying. During this quarter only, SpaceX signed a deal with American Airlines and activated the service for 4 other airlines. Government revenue is also growing rapidly. SpaceX secured more than $6 billion worth of multi-year US government contracts for its Starshield system. Obviously, Starshield is the US government system, not SpaceX's system. So Starlink is not merely developing another broadband provider. It is becoming a global communications infrastructure business serving airlines, ships, mobile network operators, companies, and also governments. And there's Starlink Mobile, of course. Well, Starlink Mobile has received one of its most important regulatory approvals. In practical terms, once the necessary satellite coverage is available, mobile phones will be able to connect directly to Starlink. That means that perhaps 3 years from now, where you are, let's say, watching Netflix somewhere on the beach, your internet connection may no longer be coming directly from O2 or Vodafone or EE. It would come from directly Starlink. That represents a huge new market for SpaceX. And looking at the division as a whole, connectivity remains SpaceX's current cash-generating engine, aka the cash cow. This is the part of the company that is actually producing profit. The third division is AI, which is where the quarterly report delivered its biggest surprise. AI revenue grew far more quickly than analysts had expected. The division generated approximately $2.5 billion of revenue, representing a growth of 213% compared to the previous quarter and 247% compared to the same period last year. Well, the division also includes advertising revenue from X, aka Twitter, but the overwhelming majority of the revenue came from, of course, AI. Specifically AI solutions and infrastructure. That figure reached roughly $2.2 billion. This brings us to the backlog, which is an important but often misunderstood term, so I think it's worth to know what it is actually. Backlog refers to the value of contracts that have already been signed but not yet have been fully delivered, recognized as revenue as well. So this is not money that is already sitting in the company's bank account, but it is not merely an optimistic forecast either. These are contracts that already exist with the services due to be delivered over the coming, let's say, months or years. SpaceX's total company backlog stood at $14.5 billion at the end of the quarter. The most important development, however, was the improvement of profitability. The AI division still recorded an operating loss of roughly $1.2 billion, but compared with the previous quarter's loss of approximately $2.5 billion, that figure has almost halved. This is a point that could completely change SpaceX's financial story. At the time of the IPO, AI was still an enormous financial black hole, basically. By the second quarter, however, we could already see the possibility of this very division might become the company's fastest growing profit engine. Probably it will be. And now we come to one of the most important questions as investors. How financially stable is the company right now, and how much additional funding does it need? After all, the worst thing that can happen to us as investors is buying a company which then goes bankrupt, goes bust. SpaceX ended this quarter with roughly $100 billion in liquid assets. So in the short term, the main risk is definitely not that the company runs out of money and collapses. SpaceX currently holds more cash than entire market capitalization of many large listed companies. But where did all this money suddenly come from? Well, partly from share offering, which is aka the IPO that was in June, and partly from something many people forget, the bond issue. The company raised a further $25 billion by issuing bonds with maturities ranging from 2031 to 2056 and interest rates between 5.35 to 6.65%. For comparison, let's look at SpaceX's bond maturing in 2033. It currently offers a yield around 6.44%. By contrast, the UK government bonds offer roughly 4.7%, Romanian government bonds offer 6.22%, and the US government bonds approximately 4.5 to 4.6%. The key point is that SpaceX is paying around 1.8 to 1.9 percentage points more than the US government for financing with similar maturity. This is not an extreme risk premium, but it is not cheap money either. SpaceX therefore needs to earn returns on its investment that are materially higher than its borrowing costs if the bond financing is to create value for shareholders. Obviously, that is the main goal. And the money raised through these offerings is being spent at an extraordinary rate. The capital expenditure in the second quarter alone was $18.3 billion. Of that amount, 86% was connected to the AI division. And this is one of the company's major risks, I think. If enthusiasm around AI begins to fade and the market goes through a period of reassessment, aka bust, SpaceX could be affected severely and as severely as Microsoft, Amazon, or let's say Google. So what can we expect from the future? The main question is, of course, when SpaceX might become profitable. The company still recorded an operating loss of $143 million and a net loss of $541 million. However, the operating loss is so small relative to the revenue that if the AI division continues to improve, SpaceX could report a positive operating profit as early as the second half of 2026, which could be quite surprising to many people. Sustained net profitability is more realistic in 2027, assuming AI continues developing at this current pace. However, if there's a major downturn in the AI market, profitability could be delayed up until 2029 because such a large part of the company's path to profit now depends on its cloud-based AI operations. When asked about revenue and profitability, let's see what Musk said in the quarterly earnings. Our internal projections for reaching $1 trillion in revenue have moved up from 2031 to 2030. In addition, Musk also said that there was some chance of achieving it as early as 2029, but we know that Musk has always liked making very, very ambitious claims. And to be honest, even if 15% of the things he announces actually happen, that would already be quite something. Over the next few quarters, I expect to see a clear revenue growth and also further improvements in profit margins. The cloud contract already signed, the growth of Starlink's enterprise business, and the addition of new satellite company all points in that one single direction. The question is how quickly profits can improve and whether the company's exceptionally high level of capital expenditures remains sustainable. My view has therefore not changed significantly since the IPO. SpaceX could become one of the most important companies in the next decade. Well, based on this report alone, its business model appears stronger and its path towards profitability is clearer than it was 3 months ago, which is, I think, is good news. But a brilliant company can still be a poor investment if you pay too high price for it. Just look at what happened to investors who bought SpaceX shares at $200 during the wave of optimism following the IPO. Just a couple of days later, the stock has jumped from $135 to $200 in less than literally 2 days. So has your view of SpaceX changed since the beginning of the video? Write your answer in comments as well. And if you would like to see more videos like this, subscribe to the channel and leave a like to help the YouTube algorithm. See you in the next video.